Thanks for the very interesting topic. I have a question. Is there a growing trend to use a reverse merger as a way to gain liquidity?
Yeah, is it a growing trend?
Yeah, is it a trend?
Yeah, what I'm saying that we do not do much of that, and so the gentleman asked about something called a reverse merger, and essentially what this is, I talked about the pink sheets early on, and there's a lot of publicly traded companies that are traded and don't really have a business. Either the business has gone away, or they never had a business, or but they're sort of these public shells, and the stock ostensibly is publicly traded, although in most cases not very much. And the idea, this is sort of some creative banker came up with the idea, well, why don't we take a little private company, merge it into the public shell, and all of a sudden we'll have a public company and not go through the hassle. My response to that is you sort of still go through the hassle, you're still paying the money, and yet you don't have a very liquid public, traded security. So in a way, I think you might end up with the worst of all worlds, which is not a lot of trading, and if not done correctly, and all the compliance costs. But I think it's done by certain banks, which are respected, and where we're seeing a lot of that is China. I think they're U.S. This is sort of a U.S. export to China, it seems these days. We have bankers going over there trying to sell companies in the PRC this arrangement to merge with a U.S. public shell. So the answer is I am seeing a lot of that. I'm myself, I'm concerned about it, and if I had a client that was proposing to do it, I'd advise them to be really careful and look at what they're getting at the end of the day, and is it worth it?
So we didn't see the approach to this new robust market.
Just asking you a question. I can't see New York. Thanks.
So you give us two main approach to this robust market that you're referring to, and the third one being a holding period for investors. My question is, how long will that holding period be? Do you think it would provide any adverse effects as far as liquidity, like increases liquidity to those loans?
Yeah, it's a good observation. So what happens today is that if you buy stock in this private placement world I've described, you buy stock from a private company, you've got a holding period of a year before you can resell it safely, let's say. And what I actually proposed was, and you've got to do that today. You've got to meet that holding period, and I mentioned that's sort of this regulatory trade-off for selling by a lot of compliance costs. The policy rationale, by the way, is, hey, we don't want companies to sell at a private placement, and the people we sell to, all of a sudden, to dump this stuff on a whole bunch of public investors. So we're going to make them hold it for a period of time, and that's the trade-off for not having all these, all the full-blown information and other requirements that exist. What I'm actually proposing is eliminating the holding period in this market as long as the recipient of the stock meets the same accreditation standards that the initial purchaser had to meet, if that makes sense. So in other words, why do you need today, if I'm Goldman Sachs, clearly I'm a sophisticated investor, I don't need a lot of protection, because maybe I do, given what we all just went through, but let's posit that they don't need much protection. And today, if I'm Goldman Sachs and I buy stock privately and I want to sell to Sequoia, arguably one of the best venture capital funds on the planet, to be safe, I've got to have this holding period. Why are those being protected there? And so I'm proposing that holding period be eliminated. I think on pretty good policy grounds that the transferee doesn't need a holding period to protect anybody as long as they take with the same restrictions. So I'm actually proposing an elimination of that holding period as long as the next party kind of meets the same standards. And that actually doesn't exist today. I think it should.
That's a high-level question. We knew a lot about how much more complex both the laws and the regulations that are being enacted today are than they were even a few years ago. And I wonder if you'd speak about, A, is that true? And if it is, what's the reason and what's the impact?
What was the first part of that?
Yes, we knew a lot about how much more complex the laws and everything from Congress and associated regulations compared to those that emerged not too long ago. And is that true, and what's the impact?
Yeah, complexity of the laws. Well, I think, I guess I would say that if you take each one individually, I'm not sure that each one is any more complex than something you might have seen 15 years ago. But, you add complexity and you add a law on top of a law on top of a law on top, and pretty soon the combined effect gets pretty complex. And so what we've really got, I think, is this, I'll call it a death by 1,000 cuts sort of thing going on where, you're just piling on additional levels of regulation. Now, I think there is some complexity there. I mean, I think this provision of Sarbanes-Oxley that I talked about was unbelievably complex, and that's why it exceeded the SEC's cost at $95,000, ended up costing some of my clients millions of dollars, and they were just incredibly unhappy about it. As you can imagine, getting a quote for $95,000 and having the bill come in at $2 million, you tend not to be real happy about that. And that was really complex because there was not a lot of guidance, and the auditors were being asked to do something that they didn't know how to do, and the companies didn't know how to do it, and the people that wrote the law didn't really know how to do it. So actually, something I'm kind of proud of is that on that front is that our SEC Advisory Committee said, trash that, adopt a whole new standard. They did. It's still there, but I think it's a little bit more, the new accounting standard in that area is helpful. So, I think it is, it's a combination of just the sheer weight of all of it. And then, yes, we live in a world of, ID tags for data tags. We live in a world of, GAAP and non-GAAP numbers. We live in a world of, currency exchange complexity. So I think it's a combination of those factors.
First, let me congratulate you for having a very wise spot of the game. I think you're very nice. My question was, I worked in the trenches of the .com boom and so forth, and to be frank with you, there was quite a bit of boxing going on. I've seen a tremendous amount of capital be invested in ventures that I don't think they ever had any potential of going anywhere. So I'm just wondering if there's a positive side to this liquidity decrease, in the sense that because we can't take our money and run as quickly, we might have our, properties and forwards and data packers, and you will be shy. We just want to take the money and run. And the capital will be better invested in the long run.
Yeah. I do think there is, I think I mentioned briefly that I do think there is, there's all of these I think are well-intentioned. I noted that the Sarbanes-Oxley and Dodd-Frank have resulted in better corporate governance, more shareholder rights, greater transparency. I mean, those are things it's really hard to argue with. I would say, I would answer your question by saying that the venture capitalists were pretty sophisticated, invested in a lot of lousy companies, it turned out. Shame on them, they're sophisticated. We took them on as clients, shame on us. I think we were all fooled during that era. But I think your point makes is most forcefully made in the area of public offerings. And so I do think that there is a societal benefit, if you will, of having higher quality IPOs targeted at the retail investor. It's just that at some point, I think what I would observe is that at some point you get to the law of diminishing returns and actually start to cut the other way and impair capital formation. And I'm nervous that we're either approaching or beyond that point, given what's happening to the venture industry. But I would agree with your fundamental point that it's a good thing that pay-per clips on the internet that got started 2 years ago isn't selling stock publicly to widowers and orphans. So I think there is a societal benefit to some of this regulation.
Just a quick kind of overload question. Curious from your perspective, how much does venture capital liquidity suffer from government debt or stimulus spending?
So for government-led
government debt or stimulus spending, how much would you say is going to cover that?
Boy, I don't know that I've got a good answer to that. I would think those effects are indirect, and maybe I'm going to see if one of the esteemed economists in the crowd might have a better answer than me to that one. Anybody have any views on that? I think it's a good question. I think it's a really good question. I don't have an answer for you. My observation, though, is that they go to T. Rowe Price and insurance companies and large pools of money, and those pools of money exist, and there something interesting did happen, which maybe is answering a different question. But you know how I said that some of these money managers will allocate 10% or so of their investment hypothetically to venture. What happened when a lot of their other investments shrunk, that 10% became a larger portion, and some of these money managers were actually out of compliance with their own provisions, and they had to sell, in some cases at a fire sale, their venture capital investment. So I think these, it's clear. I think if we learned anything during the financial crisis, we learned that a lot of these things are interrelated. I mean, who would have known that our real estate mortgages brought down the world economy, packaging them and slicing them up into bits and bytes, and that was the cause of the financial crisis.
I know that the regulations and the rise or desire to protect the public investor have resulted in fewer high-risk but potentially high-yield companies out there that the public investor could have gotten as part of their portfolio. I don't think they're out there. I wonder if that's what you're seeing, that we're changing the rate of returns on the stock market average overall because we're taking out those really high-risk but yet potentially high-return companies.
That's really interesting. I don't have a good answer to that either, but your point is that if you take the company public later in its life cycle where it's more mature and presumably has higher revenue and a higher market cap, the public investor isn't benefiting from that market cap growth up to that point, and I think that makes sense to me. I think somebody would have to study the long-term effects of returns to know that for sure, but I certainly think so. And I think it's a blessing and a curse. If you're the venture investor yourself, you're sort of having to shell out more money and take more risk to get there. But on the other hand, you're benefiting from, when those companies make it, you're benefiting from not having to share that growth.
And it's a blessing and a curse to the less savvy public investor who doesn't have opportunities to make as much money as they want to put in.
Yeah.
Thank you for a very interesting lecture. I learned a lot. In fact, as a political scientist, I think everything you told me was brand new.
That's a good thing. That's not a good thing.
But as a political scientist, I was really interested in your statements about the federalization of corporate governance. And, some of it would argue that that's a good thing in the sense that if you leave it all to the states, corporations can gravitate to those states that have the least robust regulatory scheme. So my credit card bill always comes from Delaware, I understand. Mm-hmm. But you seem a little critical of the federalization of corporate governments. And I'm just curious to hear your thoughts on that. Is that a trend that you don't like, or is it that these are just specific regulations that you object to?
I'd say all of the above. I think many of the specific regulations and the trends of things I worry about. We have, where does it, we now have shareholders voting on a whole range of things that they never used to vote on before, and where does it stop? You vote on strategy, you have executive compensation and takeover devices, and theoretically it can go on and on. So I don't like that trend. I think shareholders should have fundamental rights, but I think that disinterested directors, independent directors who get the information and sit at board meetings and have fiduciary duties are the ones that I think are in the best position to make decisions like strategy and comp. So I would take issue with both of them. I think that I'm a fan of Delaware law. I and I think there is clearly a choice of forum thing going on in the country because everybody gravitates to Delaware because of those very business-friendly statutes. Although, boy, I read all the cases that come out, and they're, directors who don't do their job or aren't disinterested. In other words, they have a conflict of interest, or in some cases treated pretty harshly in Delaware. So I'm a fan of the cases. I'm a fan of the judiciary. I'm a fan of the predictability of how directors ought to behave and how they're treated when they don't behave. And I am wary of an additional federal regulator getting into the act, getting politics into the act of how corporations are governed. But I think that's something reasonable minds could differ on. It's a good question.
It's often said that the folks in Washington, D.C. don't understand what investors and entrepreneurs in Silicon Valley want. Do you see a big difference between what regulators in Washington, D.C. want versus what investors and entrepreneurs here in Silicon Valley want? And if so, what would those differences be?
That is also a good, difficult question to answer. I think that, I'll just give you I'll give you a little vignette of a story. We have something that the venture industry right now is fighting very hard is registration. Under Dodd-Frank, private equity firms now have to register, venture capital firms don't. And so Congress and the SEC, but really the SEC, with a mandate from Congress, is trying to figure out how do we define venture funds different than private equity firms. And, I was pleased to see, I got a call from an SEC commissioner, and I got calls from the Division of Market Regulation. So I think they do reach out. They are interested. They have this small business forum. But right now, mostly what's motivating the regulators, the overwhelming tide, I think, from what I observe, is avoiding the next Bernie Madoff scenario. I mean, that is in their minds. That is the pressure they're getting from Congress. That is what Dodd-Frank has told them to write regulation to do. This vast array of things. So I would say they listen. They're interested. Right now, it's not a good time to listen to the cries of small business. But I do, and I think Silicon Valley has been notoriously absent in Washington for a long time. I think we're getting a little better at it with groups like the National Venture Capital Association and Joint Venture Silicon Valley and organizations like that getting more active. So I'd say it's mixed. I think we do have venues, but this isn't a good time to make pleas for small business. I didn't read that one. Certainly the Obama administration early in its tenure did provide government loans to some big companies, including some clients of ours that, public information. I mean, Solyndra got a solar panel manufacturer got a multi-$100 million loan from the government. Tesla got another loan, so some of that's going on. Will those prove to be good or not? Should the government be in the loan business? I think those are how it's going to turn out will remain to be seen. Is it a good or bad idea? I'm going to invite Terry or Jack or somebody to answer that question. We have much more able political scientists and economists, so I'm going to punt that one, if I may.
It seems like most of the regulation that comes out of Congress is always in reaction to the last crisis, the last fraud, the last brain made off. And I'd like you to comment on, you mentioned, I guess the SEC is looking to be proactive, sort of looking for the next scam. But in those regards, both from the Congress standpoint and the SEC standpoint, what's the track record?
Well, it is, I mean, we do, both of those giant pieces of federal legislation are basically legislating in the rearview mirror, right? I mean, Sarbanes-Oxley dealt with a crisis that just happened, and you put rules in place, and Dodd-Frank is dealing with a crisis that just happened. I would say the Dodd-Frank, we won't know. I'd say Sarbanes-Oxley mixed. I think some of the provisions didn't make sense to me just from a philosophical point of view. We can talk about those maybe at the break. I think the 404 experience, the crisis that spawned Sarbanes-Oxley was thought to have problems with loans to officers and internal controls out of whack. So when you put in place this giant regime to require your auditors to audit your internal control environment, and we talked about the impact of that. So I don't think that was not a happy experience for anybody that paid those early bills to their auditors on 404. So I think it's mixed. I think other types of regulation have been good, and other kinds of other aspects of Sarbanes-Oxley, I think we're fine. So I'm not super critical of SOX, other than the 404 provision, and other than my concern about just how much does it take, how much more does it take to be a public company in the United States, and how far are we going to go, and how costly is it going to be, and how much compliance regime, and at what point do you get to a point where foreign companies and even U.S. companies just say, let's list in Hong Kong, let's locate elsewhere, and that's what I meant about the fragility of our ecosystem. I mean, presumably at some point, there is there's a point at which businesses will just simply say enough. And so, I just observe what's happening in the liquidity environment with concern.
So, my question is, currently, is there any regulation or kind of legal approach towards the leverage management by also other kind of manipulation that try to put the value of the firm as a net variable before sale to the particular party, so that other than the firm that go from public, then private, then go back to public?
I venture I covered all of that, but you were talking about the phenomena, I think, of private equity firms sort of taking public, buying out companies. Was that kind of
Yeah, my question is what kind of regulation towards those kind of companies?
Well, I think each of those steps along the way, I think inherent in your question may be some suspicion about private equity firms sort of buying at a discount, growing, foisting upon the public, if I can put it that way, having an unfortunate circumstance, buying again. We have seen some of that. I certainly think that some of the liability provisions, we have much more enhanced liability kinds of provisions now, much more, many more requirements regarding conflicts of interest and executive pay and director independence. So I would say with respect to that particular issue and that, I think what should be some healthy suspicion whenever those things happen with regularity with the same company. I think many of those actually are addressed by pieces of Sarbanes-Oxley and Dodd-Frank. We have lots and lots of new regulation regarding conflicts of interest and executive compensation and relationships of directors to others and those kinds of things.
Well, the nice thing about me having a microphone is I always get ask the last question. So, and we are just about at that time, but I'm curious, how much discussion do you see at SEC or in the NASDAQ about, kind of the whole concept of type 1 and type 2 errors? The burnouts, the type 1s where you see someone go wrong, you like to correct that error. Regulations are designed for that. Every regulation also leads to type 2 errors. For companies that would have been successful had they not had the cost of the regulations imposed on them, might have at the same time grown and turned into a job creator as well as an innovator. And so does that discussion go on within those groups, or do they get just focused on type 1 error?
So spin it up a little bit more. So a type 2 error would be
where the regulations themselves would be the costs that prevent companies who might otherwise have gone public from going public and creating the jobs and innovations that they might otherwise do.
Well, certainly right now, I'm not sure there's a lot of that kind of talk going on in Washington. From what I can see, it's we've got a heavy investor protection mandate going on right now. You certainly have a lot of, there are people at the SEC, and I think there are commissioners at the SEC who I've talked to that I think are very business focused, people who do come out of private enterprise and do look at that. I think the whole concept behind the SEC Small Business Forum is sort of designed to do that, to allow people to come in and tell to tell at least that regulator about their frustration. So I think that concern is sort of the same answer I gave to the gentleman earlier. I think there are venues and forums for that concern, and I think the regulatory tide is just interesting to watch the agency over time. I mean, there is an ebb and a flow depending upon what's going on in Washington and what the problem of the day is, and is it we're trying to solve a financial crisis or trying to help small business? And so I think that tide blows in and out. And right now, I think we're in we were a couple of years ago in a mode where it was sort of the SEC is a helping hand to small business and in the customer service arena almost. That's how it felt when you listened to the agency, and I think now we're in a realm where it's the SEC as policeman.
Thank you, Steve. That was a great lecture.